Hi, this is Sean Overton with ForexNews.com and OneStepRemove.com. In this 5-minute video, I'm going to introduce you to a trend trading strategy. You can download the file as an expert advisor for your MetaTrader 4 platform. If you don't already have an MT4 demo account, you can get a free one from Oanda by clicking the link under this video. Trend trading strategies are designed for when the markets pick a strong direction, either up or down. All that needs to happen is for the market to go somewhere in a consistent direction over a long period of time. That's the situation where you would expect a trending strategy to work. One of the larger trends I've seen in my Forex career was the collapse in the pound yen from about 250 down to 118. That's a mind-blowing 13,200 pips of movement. That sounds exciting, doesn't it? It's important to keep in mind that a move that big took 18 months to play out. Even when we talk about trends, it's not all action all the time. There are days with big moves, days where the market goes against you, and days where nothing happens. The slow rate of change and the patience required creates a huge psychological component that you need to evaluate. Trends only happen 30% of the time. If you're running a trend trading strategy, you should expect to lose about 70% of the time. Can you picture yourself losing 70% of the time? If not, then you can rule out a trend trading strategy as the type for you. It's just not something that you're comfortable with, and if you're not comfortable, you're not going to stick with it. However, if you're willing to endure losses and you have the mental stamina to deal with choppy markets on a consistent basis, then maybe a trend trading strategy is for you. A realistic expectation for trend trading is not a strategy that makes money all the time because, as we discussed, the markets don't trend all the time. If you're looking for trends and the market is range trading, which I covered in a previous video, there's no money to be made with a trend trading approach. What does that mean for performance in a ranging market? The best case scenario is a minor profit, but that often means that it comes at the expense of long-term performance through the use of aggressive stop losses. A better balance of competing interests is to expect the trending method to eat small losses while the market chops around. The best solution is to run combinations of strategies. Most traders get hung up on the idea of finding the holy grail. They think that entails finding one strategy that makes money all the time. The realistic best case scenario is that you find a mix of strategies that, when combined, result in smooth, consistent performance. You want a mix where one strategy makes more than the strategies that's losing. Trend trading is only an element in the mix. The next step is to identify a trend trading strategy. What that means is that you have very loose stop losses and you let your profits run. It also means that a small handful of trades account for the majority of the performance. If you place 100 trades a year, it's quite possible that only 2 or 3 trades account for the majority of your gross profits. Because trend trading relies on outliers, which by definition are rare, missing even one signal can be absolutely devastating to the account. If you're running an expert advisor, it's critical that you are up and running all the time. You cannot afford to be down. You need to trade with a virtual private server with guaranteed 99.9% uptime, and you need to do everything in your power to test the expert advisor before you go live. One signal can be the difference between making money and losing money. An example EA would be a simple moving average cross. You take a fast moving average and a slow moving average. Say that the fast period is 20 and the slow period is 50. You would consider buying when the 20 SMA crosses above the 50 SMA. The fast SMA will cross above and below the slow SMA over and over again in ranging markets. That is not a good thing. Every trade costs money, and more often than not, the signals are wrong. That's because the market's mostly range trade. But whenever the market does pick a strong direction, then your strategy will buy because the market's going that way. That's the real advantage to a moving average cross. The entry signals are not great, but when the market does get some wheels, it rides the trend by not exiting early. The trend does all the heavy lifting while the strategy just goes along for the ride. MA crosses might miss out on the first 25% of a trend and give back all of the potential profits of the last 25%. Again, this is not a ticket to consistent performance. Trend trading is only suitable for traders interested in the net final outcome. These types of systems do their best when there's some type of massive fundamental shift in the market outlook that sets the tone for the next 5 years. Examples would be the end of quantitative easing or a collapse of the Chinese miracle. Longer-term charts are where you're most likely to uncover the greatest opportunities. The trends are stronger on longer time frames. If you don't already have a free MetaTrader 4 demo account, you can get one with Oanda by clicking the link below this video.